Hello everyone. Thank you all for attending 2021 Rural Research Symposium. I welcome you to the second panel of the symposium. I am Jaya, Senior Economist at Client and Community Engagement Division at Freddie Mac and will serve as a discussant for this panel. Our panel will focus on defining rural America. There is a lack of consensus on what is rural and how is it different from non-rural areas. Policymakers and practitioners have argued that mortgage borrowers in rural areas are potentially less well served than those in other areas. In this session, we will explore and learn various approaches to define rural, which will deepen our understanding of rural housing challenges. We have three panelists in this session. Our first panelist will be Alexander Hermann. He is a senior research analyst at Joint Center for Housing Studies, Harvard University. His research focuses on projects related to housing markets, demographics, and housing policy. Before we begin the session, I have a quick reminder for the audience. Please click on the Q&A icon to submit your questions during the presentations. With that, I would request Alex to take it away.
Thank you, Jaya, and thanks so much for having me. I'm Alex Hermann. I'm a senior research analyst at the Joint Center for Housing Studies at Harvard. I'm presenting on behalf of myself and my co-author, Whitney Ergodo-Bricky. Today, I hope to discuss our ongoing research on different definitions of rural, what those definitions purport to capture, and what that means in practical terms for research and for our understanding of rural areas demographically, economically, and for the housing challenges rural areas face. Here's a quick roadmap of what we'll consider today in our brief time. I'll discuss what motivates this research and our data and methods. I'll then talk briefly about defining rural areas conceptually and in practice. We'll take a look at what those definitions mean for what rural looks like on a map. We'll then delve into key findings, and we hope to show pretty clearly your choice of rural definition really matters for the size of the rural housing market and for the scope and magnitude of challenges facing rural areas. We'll then end with some discussion of future work, implications, and conclusions. But first, what motivates our research? One prevalent challenge that most of us deal with on some level is the idea that to study rural housing issues or rural issues in general, you inevitably counter this problem of a lack of good data. For example, it's a common refrain at my center to pose a question about the geographic variation in a trend and to ultimately hit a wall when that data is just not available. Sometimes at your disposal, you have an imperfect proxy for the trend you really care about. And even though that's true for all research, really, it holds doubly true for research on rural areas. Oftentimes, as a sort of compromise, researchers are forced to define rural based on practical considerations, just like data availability or geography. Our purpose with this research is to show that these practical considerations can't be the only or even the primary means by which researchers make choice to define rural areas. That's because this choice matters significantly for how large your rural housing market is and for the scope of challenges rural areas face. So ultimately, as researchers of rural areas, we need to be careful, considerate, and intentional about what we define, what definitions we use. Our data methods are actually quite simple. We've replicated or acquired 9 different definitions of rural areas at 4 different levels of geography, at the county, zip code, census tract, and urban area or urban cluster level. From there, we take these definitions and map on relevant indicators from the 2019 American Community Survey 5-year estimates, which of course are available at all levels of geography. We ask the questions you see in front of you, right? What do these different definitions of rural tell us about the size of the rural housing market? What do they tell us about the scope and extent of rural housing demographic and economic challenges and realities? Before digging into the precise definitions, I want to start first by talking conceptually about what some of the common ways researchers define rural. First of all, rural is often defined in opposition to or as the absence of urban. So we'll take what we define as urban, and then everything left over is counted as rural. Rural areas are also often defined by some population threshold, and then relatedly by both population and household density. Other common definitions consider how accessible rural areas are to cities or job markets, how economically interdependent or disconnected they are to those cities. And that, of course, can be related to commuting times and physical proximity also. We also define rural areas by people's perceptions, usually of the place they live. Do you consider your neighborhood to be rural? And lastly, though I won't get into this a great deal, there are some typologies within rural also, right? Defining the kind of rural area based on one of the above characteristics, or based on geography, or based on certain economic characteristics. One thing that I hope is clear is that many of these criteria can overlap, right? Definitions can use multiple criteria. They can apply that criteria to defining an urban area and then backfill an understanding of rural based on that urban criteria. So really, there's many ways to think about what makes rural areas actually rural. We've created 4 categories of rural definitions ourselves from this conceptual list. Residual definitions define urban first in some way and then call everything else rural. Definitions based primarily on character consider what the attributes of rural areas are first and foremost. Think density, adjacency, commuting times. And then perceptual definitions are based around the question, what kind of area do you live in? Is it urban, suburban, or is it rural? And lastly, definitions based on policy consider the policy implications of the definition at their core. For this presentation, we've pulled together 9 definitions of rural, and we've condensed them into these 4 categories. Note, just like the conceptual definitions, there's a lot of overlap here, and you can probably quibble to some extent with most of these. And we'd be happy to hear any feedback on that. The slide shows how each definition will be abbreviated for the remainder of the slides. We'll get at the characteristics in a second, but our 2 residual definitions are the OMB and census definitions of rural. Those based on character come from the Housing Assistance Council, but also the USDA's Rural Urban Commuting Area and Rural Urban Continuum Codes, so the RUCA and RUC codes respectively. 2 perceptual definitions come from HUD and Trulia, and then the 2 policy definitions are USDA's eligibility criteria and FHFA's duty to serve. This table shows those 9 definitions, the year of the update we're using, how often the definition actually gets updated, and the level of geography the definition is defined at, and how rural is actually defined itself. It's worth noting that there are some differences in how these definitions are acquired or replicated and how we produce our estimates. But for time considerations, I'm not going to get into any detail on that right now. I'll talk to the definitions a little bit as we go through some of these maps. First, let's look at our 2 residual definitions. Green in all cases indicates a rural area. OMB starts by defining metropolitan area and micropolitan area counties based on population and adjacency. It then categorizes every other county as non-metro, which is a common proxy for rural. Similarly, the census defines urban areas and urban clusters first based on population and population density and adjacency, and then categorizes everything else as rural. The first thing that should be clear from our first 2 maps, right? Even within one of these big 4 categories, there's a considerable amount of variation of what gets defined as rural. And you can quite clearly see that the potential differences in area are quite vast as well. So on to character now. HAC defines rural areas as census tracts with under 16 housing units per square mile. The RUCA codes define rural areas based on commuting flows to tracts outside of urban areas and urban clusters. And the RUC codes are defined at the county level. So within non-metro counties, places with an urban population under 2,500 people are defined as rural. So to be clear, there's a considerable amount of nesting even within these definitions, right? Rural definitions built out of other rural definitions. Note that for this analysis, we almost always choose the most restrictive definitions of rural from these sources, but ultimately in the paper, we'll look at some of the sensitivity to those choices. For example, what happens when you include small towns by the HAC definition or micropolitan areas from OMB. But today I won't show you any of that. We're going to get down to the most restricted portions. The perceptual definitions generally cover a larger share of the country, though there are some important differences between the 2 measures. They're both fundamentally based on surveys that ask people to define their neighborhood as urban, suburban, and rural. These perceptions are then combined with neighborhood and regional characteristics to predict the likelihood any given tract or zip code would be seen as rural. Both policy definitions are defined at the tract level and cover an even larger share of the country. FHFA defines rural as all tracts outside of metro areas or a tract within an MSA, but it's outside an urban area and has under 64 housing units per square mile. Again, these definitions kind of get messy. Lastly, USDA defines tracts as rural based on population, based on MSA status, mortgage credit availability, and in some cases based on your prior rural designation. Let me spell out some key findings now before getting to specific examples and precise estimates. At the heart of this, I want to show something very basic, right? Choosing a rural definition matters greatly for what you consider to be rural. I think the maps already show this in some ways, but the numbers we'll get into a second are even more striking. For the most part, rural challenges and realities are directionally similar relative to the US overall, kind of regardless of definition you use, but it's worth noting that there's still often a considerable range or major differences in magnitude. In other cases, the choice of definition matters directionally even, and we'll get into a few important examples in a few minutes on that. But let's start with the most basic indicators, the size and density of the rural housing market. To give you a sense of the structure of our tables, we show the measure on the far left side, the 9 definitions of rural immediately following, and we've grouped those by our 4 major categories, right? We'll show the equivalent estimate for the US overall just to the right of that, and then we show the minimum and maximum value for rural definitions, as well as a simple average of the 9 definitions on the far right. I only have time to key in on 1 or 2 indicators per slide. Most importantly here, let's look at the size of the rural housing market, which varies considerably with the definition chosen. Rural housing markets contain 1.9 million households when using the RUC definition and 41.1 million households when using the USDA eligibility definition. In other words, rural areas might contain somewhere between 1.5% or fully 1/3 of US households, depending on your definition. And that 1.9 million household number is restrictive, but not completely anomalous either. Using any of the 3 character definitions, you end up with a relatively small US rural housing market, one with under 7 million households in 2019. The residual definitions are all larger, but range significantly from 7.2 million using the OMB definition to 23.5 million using the census definition. Interestingly, the perceptual-based definitions all give a larger housing market than either the character or the residual definitions. And then finally, the policy definitions give a still even larger number of households. So that's the FHFA and USDA definitions on the far right. This figure simply shows the number of households in rural areas and meant to give you a quick sense of the difference in magnitude. So the number of households by the USDA definition is 21 times greater than by the RUC definition. And obviously that's a range of about 39 million households. Some estimates don't vary quite as widely, right? Medians and distributions for the most part are a little narrower, but the range can still be considerable. See here the share of people of color by each of these definitions, which ranges from 17% using the census definition to 25% when using the X definition. The more expansive definitions, especially the policy ones, but also the perceptual definitions, tend to have a more diverse population because they bring in a larger chunk of the US overall. However, in all cases, rural areas are significantly less diverse than the nation overall. The bar on the far right side shows you that about 40% of the nation overall is people of color. Some other basic demographic realities. The share of the population with a bachelor's degree ranges about 6.5 percentage points, but is lower than the US overall in all cases. Likewise, the median household income ranges nearly $12,000, but is lower than the US overall median household income, again, in all cases. In general, the more expansive definitions tend to be more affluent, certainly in terms of income and education, relative to the more restrictive definitions. But poverty rates tell a slightly different story. Poverty rates can be either higher or lower than the US rate, depending on the definition used. So the poverty rate overall in the US was 13.5% roughly, and in rural areas range from 11.7% based on the census definition to 16.7% based on the RUC definition, a 5 percentage point swing. Sorry. 3 definitions have a poverty rate below the national rate. So in addition to census, you have HUD and the USDA definition, all more expansive definitions. The remaining 6 have poverty rates above the national rate, but also include the remaining more expansive definitions, most notably Trulia and FHFA. Without going into too much detail here, I want to reiterate that the exact challenges and the scopes of the rural housing stock also varies considerably depending on the definition used. And this is the rural housing stock slide. I want to focus in on 2 elements in particular. One is the homeownership rate, which varies from 73.5% using the FHFA definition to 81.5% using the census definition, all higher than the national rate overall. However, the extent of rural areas considered older housing varies even more depending on the definition chosen. For the most part, more expansive definitions show that a smaller share of the US of the stock was built before 1990, while more restricted definitions show more units were built before 1990, or in other words, were at least 25 to 30 years old. This ranges from 58.3% to 68.9%, a more than 10 percentage point swing. We have some additional research planned before finalizing and writing up our results, including kind of looking more intentionally at measures of housing costs and affordability, and considering different measures of racial equity, commuting times, and possibly some measures of spatial isolation. We also want to explore regional and state differences for some of these key measures, and do more to explore areas of overlap. Lastly, with input from Corianne Payton-Scally at the Urban Institute, we plan to think through the policy implications of this research a little more. But I'll still end with a few preliminary conclusions. I hope we've shown the choice of definition matters significantly along some key dimensions. It very likely matters even for the area you hope to research. The estimates tend to be directionally similar regardless of definition used, but magnitudes vary greatly, and even directional similarity isn't always the case. In particular, we were struck by the poverty rates being an important counterexample. Perceptual definitions tend to be more broadly encompassing. We're still thinking through the mismatch between perceptual definitions and character definitions in particular. Some evidence suggests that people are more likely to say they live in rural areas than most definitions of rural indicate, either those based on character or the residual approach in particular. In fact, people are almost as likely to see themselves as living in rural areas as they are in urban areas, which is a fact I still kind of find striking. Lastly, it's important to point out that definitions of rural also matter significantly for how resources are distributed and our understanding of the scope and magnitude of rural housing challenges. Thank you so much for your time and for inviting us here. And I'm really looking forward to any questions, comments, or suggestions people have.
Thank you, Alex, for a wonderful presentation. Our next speaker is going to be Keith Wiley, who is a research associate at the Housing Assistance Council. His areas of interest include rural housing and development, federal housing and financial oversight policies, smart growth planning and policies, and environmental economics. Keith, please take it away.
Thanks, Jaya. I'm going to talk here today about concentrated poverty in the rural Southeast. And in particular, I think this is an area that tends to get overlooked as far as high need regions. We do primarily rural research, and there's several of them in the United States and one of them in the Southeast that we're going to talk about and highlight today. And just first show this quote, because I think it's important. I think it started to get more traction in policy circles, like with the 10, 20, 30 policy to include monies to go to persistent poverty areas. But chronic poverty or persistent poverty is really, particularly in high need rural areas, it creates a perpetual disadvantage and it affects generations of people. And it's an important area and an important topic. And that's kind of what we're going to get in here to a region I think is a little bit overlooked in that, but I think it's a growing area of policy efforts. Now, this slide here puts a map out. I'm putting a map out that shows the high need regions. These are essentially areas of concentrated poverty in Central Appalachia, the lower Mississippi Delta, the border Colonias, and Native American lands. And I overlay the different shades, the orange, the pink, and then I put the boundaries in gray for persistent poverty counties as defined by the USDA. And these are counties that have had poverty of 20% or greater for 4 decades, from 1980, 1990, 2000, 2020. And what I'm doing here is trying to highlight the region we're going to focus on. So you can see there's 353 persistently poor counties using the USDA definition. The overwhelming majority of them are rural or outside metropolitan areas. In about 60%, if you change the definition of Native American lands, up to 2/3 are in already defined high need regions. But in that area from Florida up to Virginia and like Georgia and South Carolina, there's a large contiguous block that have not been part of a high need region right now, or an active high need region. I'll talk about that in a second. That's the Southeast Crescent. And it's about 1/4 of all persistent poverty counties. And that's what we're going to focus on today, those counties, defining them and looking a bit closer at them. Now, as background, there's been a lot of research on this region overall, and often it's defined as the Black Belt region, and it stretches from Virginia to Texas, and Wimberley and Morris and Womack and some other great research have defined this region, and generally it's defined as a region with above average Black or African American population, close historical link to slavery in that region and discrimination, and it's been defined as such in really been a lot of efforts to create a commission for that region, similar to the Appalachian Regional Commission over the years, the 80s and 90s and 2000s. Then by 2000, there was a commission authorized for the Delta region, which captures part of this Black Belt over around Mississippi, Arkansas, and Louisiana. And then by 2008, Congress created the Southeast Crescent Regional Commission, and that would capture the part we're going to talk about today from Virginia to Florida and over to Mississippi. But it's inactive, which I'll mention later on. So there's been a good bit of work and efforts policy-wise to focus on this area. Now here, what I've done is I've essentially duplicated the definition that Wimberly and Morris use of above average Black or African American population for the southern states. And you can see there's about 592 counties that fit that definition. And 189 of them have persistent poverty. And that's over half of all persistent poverty counties in the United States using the USDA definition. Now, 150 of them are already contained in the Delta area, the Delta Authority, or as I call it here, the Lower Mississippi Delta. And about 54 are contained in Central or Appalachia, 5 of them in Central Appalachia, which is covered under the Appalachian Regional Commission. So that just gives you kind of an idea for how many are there and how many are already accounted for in the depth of it in the region. But what I want to do is focus on those ones that aren't accounted for. It's about 300 and some, and they're in the Southeast Crescent region. And I'm going to use the framework to define them from the commission that was created in 2008. And it says it considers the states from Virginia down to Florida and over to Mississippi, those 7 states, that the counties in them that aren't part of the Appalachian Regional Commission or the Delta Authority service area. And that's what we're going to focus on, those counties. But we are going to go in and look specifically at the rural areas and the areas of high poverty and get a description of their housing conditions. So we're going to go from the county down to the smaller census tract geography, and we're going to use the HAC rural measure, which looks at housing unit density and commuting patterns and classifies census tracts as either rural, suburban, or urban, and we're going to pull out the rural ones. And then we're going to look at the high poverty tracts, the ones with a poverty rate of 20% or more, and make some comparisons and some analysis of them using that geography. Now here's a map of the area defined that way. The dark green are just the rural that aren't in high poverty. The really light green are the rural areas that are in high poverty. And overall, that region, those states cover 50 million people, but only about 7 million are rural using the HAC definition, and about 3 million are in high poverty tracts. So we're going to look at those 7 million, those tracts on there, and then we're going to specifically look at the 3 million that live in the high poverty rural tracts. Now, these slides here are just really to kind of make a comparison to show some of the things that are common that this region has that other high need regions have. And first is just a simple comparison of poverty rates. And I use the lower Mississippi Delta, Central Appalachia, and the Southeast Crescent side by side. And then the all others is everybody that's in a rural area but not in a high needs area. And I do this to show, you can see a very similar, the light bar is the poverty, percent of population in poverty. It's very similar for the Delta, Appalachian, Southeast Crescent. It's a little higher, about 22% in the Delta, but about almost 19% in the Crescent. And then the population that lives in high poverty census tracts with 20% or more, and this is all rural, is about 49% in the Delta, and it's about 44% in the Crescent and 45% in Central Appalachia. This is very, very similar and much higher. They kind of stand out from the all other rural areas. And to the right is one where I break poverty down just in that Southeast Crescent rural area by race to show another kind of hallmark of these areas is that there's oftentimes extremely high poverty rates in the not white, non-Hispanic population. And here you can see the kind of the brownish orange is in the bottom is for white, non-Hispanic. And that poverty rate's about 13% or so in these rural areas in the Crescent region. But for like African American and Hispanic, it's at least 20s or 30%. So it's a pretty significant difference. And you can kind of see this along the border Colonia region or Native American lands. It's a very stark difference. And so now I'm going to talk a bit using those defined areas on some housing characteristics. And this slide here I like because it looks at 2 things that I think most people might not think they would find. One is the home ownership rate, and this is in high poverty census tracts in the region. And again, I break it down by state. And what I'm trying to show here is I think most people think everybody in rural areas own their own home, but they don't. And here, the darker orange one is for white non-Hispanic, and you see it's about 3/4 of the households are owner-occupied for that group. But for Black or African American, it's less than 50% in most of the states. It just shows the stark difference that does exist. You see it in other areas, but I think a lot of people don't know that you'd find that in rural areas, and particularly this high poverty area. The other slide, and it's for the not white, non-Hispanic share of manufactured housing. I think a lot of times people have this idea of manufactured housing as primarily like an Appalachian thing for white, non-Hispanic households. And actually, it's very common in this region as well. And a large share of them are actually owned by Black or African American residents or Hispanic residents. And you can see here, I have the light orange bar for rural and the brighter orange bar for rural high needs. And you see that in most just overall rural areas for most states, at least 1/4 of the manufactured homes are owned by not white, non-Hispanic. And it gets up to 60% for the high poverty areas in South Carolina and North Carolina. And this is kind of an important issue because it's an important part of the housing stock and it's an interesting market, but there's also a lot of things like issues around it and like through duty to serve and stuff, the manufactured housing market. Here I have another 2 sets of slides, and one relates to the crowding issue. And I put this in here because, again, it's oftentimes not thought about in rural areas. And it also brings in the Hispanic Latino population, which is growing in many of these areas. And what you see here is I have it broken down by rural not poverty is the lightest orange, and the brightest orange or darkest orange is rural high poverty. And I'm just trying to show this is for the Hispanic, and it means more than one person per room, Hispanic or Latino households. And you can see it's over 10%, so that means 1 out of every 10 in each one of these areas for the high poverty tracts has crowded. They're living in crowded housing conditions, which is another issue of housing affordability and supply issues in these communities. And the next one is one I think people are well aware of now. It's access to internet access, especially if you have a family and you go online to do your jobs. And this is a definition of how many people live in a household with access to a computer and broadband subscriptions. This would be high-level access. And you can see for the top cubes are for white non-Hispanic, and that's over 75% of 3/4. But for African American and Hispanic, it's about 2/3. That's a pretty big difference, and particularly for an issue that really matters. And so you can also see that disparity here in the high poverty census tracts. In these last 2 slides, just look at really a measure of development, because it's one thing to think about it, but like I like to show it in figures. Like you think of it intuitive, right? But here I break down in the right the Southeast Crescent region, the Southeast Crescent rural part of the region, and the Southeast Crescent rural high poverty. And what I'm trying to show is the number of units built before 1970 increases and the number of units built 2010 or later decreases. In other words, the housing stock gets older and older because there's less built there. And that leads to other issues of accessibility and stuff like that. I think this is a good measure or a good way to look at it to show, look, this is the ramifications of less investment and development. And the figure on the right looks at Home Mortgage Disclosure Act home purchase loans. And what we did was we standardized them essentially per 1,000 owner-occupied units. And I just wanted to show the difference in finance activity. And you can see the dark bar is for not high poverty. The middle orange bar is for high poverty. And the lightest bar is for high poverty areas, African American. And you see a dramatic decline in the rate of lending. So it's 80 loans per 1,000 owner-occupied units in Alabama for the not high poverty. It's 35 for the high poverty census tract households, and then it's down to 22 loans per 1,000 owner-occupied units for the African American or Black households in those areas. And you can see that's consistent throughout. It just speaks to the dearth of financial activity and why you also see a lot of efforts to expand access in these areas. Now, just real fast, try to wrap up. When I talked about the commission, the Southeast Crescent Commission was created. It had no co-chair, and there was calls to activate it recently. And President Biden has actually nominated a co-chair. So this might mean there may be more activity involved in this, and it'd be interesting in this data, and this closer look would really be important and maybe help address some of the issues in the region. So that's all I got. So back to Jaya.
Thank you, Keith, for such valuable information. Our last presenter will be Zoraima Diaz-Pineda, who serves as a Director of Policy, Impact and Innovation at Come Dream, Come Build. As a practitioner, researcher, policy analyst, collaborative thought partner, and advocate, Zoraima is committed to creating opportunities for low and moderate income households and women of color in small communities and rural areas to build financial health and wealth. Zoraima, please take it away.
Thank you, Jaya, and I would like to thank the entire Freddie Mac team for hosting the virtual Rural Research Symposium and providing us with an opportunity to share our perspective as practitioners on the ground. In the last 47 years, CDCB, formerly the Community Development Corporation of Brownsville, has developed into one of the largest producers of affordable housing throughout the state of Texas. We are also a licensed CDFI, and our geographical footprint encompasses the southernmost counties along the Texas-Mexico border. We principally serve in Cameron, Hidalgo, Starr, and Willacy counties. In the last 5 years alone, CDCB has deployed over $23 million in small dollar loans, over $31 million in mortgage loans, and financed over $5 million of multifamily housing in rural areas. The individuals that we serve along the Texas-Mexico frontera are subject to the compounding effects of long-standing, deeply entrenched generational poverty. They are operating in an increasingly complex financial marketplace while residing in financial deserts and experience a prevalence of chronic physical disease. CDCB's housing team thoroughly reviews the household's financial balance sheets of the families that we serve in our region, and by doing so, we have discerned several quantitative metrics that inhibit a family's ability to achieve financial stability and to serve as barriers to homeownership. Households in rural areas and colonias are more likely to be led by individuals over the age of 60 who are aging out of the workforce or have aged out of the workforce and are more likely to rely on Social Security as their sole source of income. In our area, that average disbursement is a little over $794 a month. And during the pandemic, we witnessed that it was increasingly difficult for elders in our community to shelter in place, especially when their housing stock was dilapidated. Also in our community, there's a higher incidence of elderly individuals not only aging in place, but also residing in multi-generational households, all which points to the urgency of a need for more affordable housing solutions. In terms of our financial pulse, when we look at a household, we're trying to determine to what extent does their income strong enough to enable them to move towards home purchase. You can see here even a discrepancy between the households that we serve in metro areas and in rural areas and colonias. 75% of households in rural areas and colonias are under 80% of area median income, and 44% are under 50% of area median income. In terms of income that's available to the household to purchase a home, again, you see the discrepancy here where in metro areas, the average annual household income is a little over $37,000. But in rural areas and colonias, the average household income is slightly over $30,000. There's also a second piece that's very important to note. In terms of the household income that's available to allocate towards the mortgage purchase, towards applying for a mortgage loan, in colonias and rural areas, the average household income is $27,000. Now, we see this discrepancy because, again, as I mentioned, we exist with many multi-generational households where you may have an elderly individual who receives SSI who brings that income into the household, or a young person who's working part-time who also contributes that income to a household. But for the individuals that are applying for the mortgage loan, we can only consider income that's available towards that mortgage purchase. In terms of our financial immune system, you can see here that over half, 1 out of 2 households, did not have any savings. Not just savings to cover 3 months worth of expenses, but no savings with a financial institution or even mattress money at home. In addition, of the households that did have some savings, the average savings for the families in rural areas, colonias, was a little over $1,700. In terms of our financial cholesterol, we're trying to gauge to what extent are their financial arteries so clogged that their income is not able to be allocated towards a mortgage payment. You can see here that in terms of the families that live in colonias or rural areas, they do have a slightly smaller debt load in comparison to metro households, carrying about on average 21% debt to income ratio. In addition to that, the amount of money monthly that they're allocating towards debt payment is slightly lower, with the average being $489 a month. This is critically important because we realize that families could be allocating part of that $489 not just to debt payment, but towards a mortgage for a home. In terms of our financial blood sugar, you can see here, the majority of the households that we serve are credit challenged. The average credit score for a metro household is 607, and that of a household residing in a colonia or rural area is 560, far below what's necessary to qualify for even the basic FHA loan. In addition to that, we also serve a significant number of households that are credit invisible, around 9%, that have no formal credit history when they enter into housing counseling. In addition to our financial blood sugar, we also know that 59% of households are credit stressed. They already have at least one account past due, and 39% of households have at least 3 accounts past due when they enter this journey. In addition to that, we also know that there's a heavy reliance on high-cost alternative financial products, and 36% of households have at least one account open with a predatory provider when they enter housing counseling. In terms of the cohorts, we've identified that families that we serve in rural areas and colonias generally fall into 2 primary cohorts. One, that they're elderly, meaning that they have lower income, very low assets, and limited formal education. In addition to that, they fall into the fixed income client cohort, again, meaning that they have low incomes, they have low net worth, they do have slightly lower debt profiles, but they also rely on SSI or SSDI as their sole source of income. Now, many of the households that we serve, again, we've identified through this deep dive into their household financial profiles, fall into what we consider to be a chronic cycle of financial illness. And we've characterized this into 8 basic metrics. First and foremost, they have low wages or they're on a fixed income. As I mentioned previously, historically, we served many households that were migrant farm laborers, meaning that their income adjusted seasonally based on a harvesting season. Now we have fewer and fewer households that are in a migrant farm labor servicing pattern, but they're just moving between low-wage employer to low-wage employer. This means that they're not salaried. It's very difficult for them to predict their income for this month, much less for a quarter, which increasingly makes it difficult for them to save for an unexpected emergency. In addition to that, we also often hear that it should be easier for the families that we serve to cover all of their basic expenses because of the lower cost of living in the regions that we serve. Unfortunately, this is untrue. We increasingly see that the region that we serve presently is the least of all 26 metro regions throughout the state of Texas, meaning that it's harder for the families that we serve to cover all of their basic living expenses, much less save towards the down payment of a purchase of a home. In addition to that, the families that we serve suffer from high rates of income volatility, and they experience several spikes and dips in their income, which again pushes them to the need for high-cost predatory short-term debt products. In terms of liquid asset poverty, we know that our families' financial immune systems are in a dire strait. Not only are they unable to cover basic expenses for 3 months should they experience an unexpected financial emergency, increasingly we see that these emergencies are recurring constantly, whether that's experiencing an unexpected job loss, a natural disaster, the onset of COVID-19, or just rupturing 2 tires in their car and being unable to arrive to work. Increasingly, families are unable to withstand unexpected financial shocks. In terms of debt and credit challenges, we also know that credit is an increasingly important part of purchasing a home or achieving financial security in the short or long term. As I mentioned previously, we exist in a financial desert, and the ratio of mainstream financial service providers to alternative providers in Cameron County, for example, is 1 to 22. We know that many of the families that we serve really operate outside of the financial mainstream in the predatory service market. The providers in this area are evolving constantly, and we have witnessed that they are building financial empires off the permutation of the provision of credit products to those who can least afford to pay. And they are increasingly tempting consumers under the guise of what seems to be assimilation into the financial mainstream. We are basically witnessing families essentially spending a lifetime living in the red as they face insurmountable and reoccurring liquidity constraints. In addition, we also know that in many traditional households, something such as an inheritance can serve as an asset that enables the family to make a home purchase. This is called a Head Start asset. This term was coined by Thomas Shapiro in his groundbreaking work. We, in the community that we serve, increasingly see not Head Start assets, but what we consider to be catch-up assets, as individuals are flowing as financial resources not from parents to children, but from children to parents. We also see that in this catching up of assets, there's more of a transfer of financial resources within a generation, as siblings encourage each other or help each other to access financial services. In addition, we also see that increasingly there's a perilous financial habit, of which we refer to the unhealthy practice of snacking, the sharing of Social Security numbers to access credit. Social Security numbers represent a highly coveted form of financial currency in our community and something that individuals depend on in order to access large financial purchases. Similarly, we also know that households their financial fates are very, very entangled, and these financial threads can be very stressed when households are depending on each other for financial resources. We also know that there's a lack of financial information, financial literacy education that is bilingual, that is also bicultural, and that individuals seek advice when they're at the tip of a financial emergency or an impending negative transaction is about to occur, such as the loss of a vehicle, a foreclosure, or even an eviction. In addition to that, we also know that the majority of households that reside in rural areas and colonias, specifically here we're speaking to women and female-led households, are increasingly engaged in not just one, but multiple full-time jobs. However, they are tied to low-wage caregiving professions such as home health, daycare assistants, or nursing facilities, in which they not only earn a low wage, but they're not considered full-time at one employer, meaning that they lack access to critical health and retirement benefits. Increasingly, they are working harder and harder and aging into poverty. Now, I know that the above-mentioned statistics are somewhat sobering, but we feel that it's important for us to acknowledge the financial numbers, to know our financials in our community, because this is necessary to inform how we will treat the root cause of chronic financial illness and how we will develop financial products to meet clients where they are. You can see here that in terms of quantifying financial dreams, the average household will reduce their debt-to-income ratio by 5%. They will increase their credit score by 82 points. They will reduce their monthly debt payments by $106, and they will save close to $5,000 towards the down payment through the process of working with a housing counselor at CDCB and able to purchase a home. Now, as I mentioned previously, the condition of the housing stock currently is what continues to serve for CDCB and our staff as motivation to develop financial products and services that meet clients where they are. The data points that I have mentioned allowed CDCB to produce the innovative financial product, which we have now called Mi Casita, a loan that enables families to build a new home on their property and grow the physical structure and the mortgage note as their family size increases or their financial stability also increases. We are grateful for the opportunity to engage with partners such as those attending the Rural Research Symposium and to share some of the pitfalls and promises that we've encountered in our journey, because we realize that we cannot wait for someone else to create solutions to address the quandaries of wealth inequality and the inability to access affordable housing. We have to operationalize solutions to close the massive wealth gap in the communities that we serve. In addition to that, although we realize that our clients are facing a complex social realities, we also know that the families that we serve are contagiously hopeful. They're persistent in their pursuit of better opportunities. They're entrepreneurial in their financial endeavors. They're resourceful in how they leverage their social, human, and financial capital, and creative in their approach to challenging the status quo, resilient in the face of formidable obstacles, market trends, and structural inequalities that are beyond their control. Our small team is committed to writing a narrative that highlights the tenacity, hope, resilience, and dignity of the families that we serve in rural areas and colonias as they work to purchase a home and build wealth for themselves and our community. CDCB is striving to change the intergenerational wealth trajectories of the families in colonias and rural areas that we serve through the provision of affordable housing and sound financial products and services. In addition, we are also working to influence the development of equitable local, state, and federal policies. We encourage you to visit our website to review our fact sheets and to learn more about our new Housing Instability art installation that is bringing visibility to the challenge of housing displacement in our region. Thank you again for hosting us, and we're excited to engage in the discussion. Back to you, Jaya.
Thank you, Zoraima. That was a lot of interesting information. With that, we are now going to transition to the discussion part of the session, and then we will open it up for Q&A. So if you have questions for our presenters, please make sure to submit them by clicking on the Q&A icon if you haven't already done so. So I think I learned a lot from all the three subject matter experts. They presented various perspectives and metrics which deepens our understanding of what is rural. I'll summarize their findings with some comments and questions. Let me start with Alex. I echo with him that that this is such a relevant but understudied topic due to data limitations and lack of consensus on what is rural. He provided a very comprehensive review of various approaches to define rural and implications from those approaches. I have myself co-authored 2 papers on rural in the past that was based on 2 different definitions. In the first paper, we defined rural using RUC code, and in my second paper, we study high-needs rural areas as defined in Duty to Serve. While working on these topics, I always wondered how these definitions overlapped. So Alex's work not only helped answer that question, but also serves as a future repository for researchers, practitioners, and policymakers for deeper understanding of the overarching definition of rural. He broadly classified various approaches into 4 different categories. The residual approach, where you first define what is urban and treat everything else as rural. The character approach, where you define rural based on certain characteristics such as number of housing units, commuting flows, population size. Perceptual approach, where it's survey-based and it defines rural and urban based on how respondents perceive their neighborhood. And the policy approach, which is a combination of the residual and character approach. His findings suggest the choice of approach matters significantly for sizing rural housing market, understanding the challenges, and scoping out opportunities. While the character-based approaches have lowest coverage of rural households, the policy-based approach have highest coverage. Regardless of the approaches, rural areas are less diverse compared to the rest of the nation. Poverty rates and share of aging housing stock may vary based on the definitions. I think I have 2 questions for his research. First is, what definition captures the most underserved rural areas? For example, the poverty rates is quite different across the 2 definitions within the residual approach, that is the census and the OMB definition. Does it vary within the 2 definitions as well, given the census definition is much broader? Is there heterogeneity within these definitions? My second question is, have you looked at some migration patterns in these rural definitions? According to Freddie Mac's research, housing inventory is declining faster in rural areas than urban areas post-pandemic. There has been increased mobility in rural areas as homeowners prefer bigger space. Do you think this is a unanimous trend regardless of how you define rural? Or do you think this trend is more prominent when you use the broader definitions and alleviates to a certain extent under the restrictive definitions? So
Thank you, Jaya. Cool. Sorry,
go ahead.
Oh, no. Do you want me to start now? I'll go to answer the question. Thank you. I'm going to start with the second one, actually, because I really like the question because it illustrates exactly the kinds of ways I want the research and we want the research applied, and the kinds of things we as research need to be thinking about when considering the questions about rural areas, right? So obviously mobility rates are important and very timely research topics for now. And it's not something we've looked deeply at, although we can in the ACS data, but it's definitely something, like I said, we should explore. But to answer your question more directly, I'd suspect that because the more restrictive definitions are generally fairly remote, lower density areas that you'd be less likely to see the kinds of rebounds in mobility rates that you've seen really the last year or so. But that's just a hypothesis, right? That can be tested empirically. And I hope our own research kind of helps motivate that kind of research, at least that kind of consideration of the importance of the choice of definition.
Thank you. All right, so Alex's work provides a great segue to Keith's presentation, who focuses on certain pockets of rural area. Particularly, he's investigating how underserved are the persistent poverty areas in rural Southeast Crescent states are. Using Hack's definition of rural at the tract level, he focuses on the subset of tracts that are high poverty. And his main findings suggest the percentage of population living in high poverty in rural Southeast Crescent states is very similar to other high-needs rural areas such as Lower Mississippi Delta and Central Appalachia. So that way, they are also underserved, even though they are not currently categorized as high-needs rural. The poverty rates are much higher for people of color compared to the non-Hispanic whites in the rural Southeast Crescent. Even though homeownership rate is high in these areas, the racial gap in homeownership rate is also quite high. And there is high ownership of manufactured housing amongst the communities of color. Lastly, the share of aging housing stock is high, and there is huge racial disparity in the lending activity. I have 3 questions for Keith. The racial homeownership gap in rural Southeast Crescent states was quite striking. Could affordability be a contributing factor? While one might argue that affordability in rural areas is quite high on average, it might not be the case for lower tail of the distribution. Freddie Mac's research shows that even though southern states seem to be very affordable overall, they may not be as affordable to the low to moderate income population, as the area median income is so low, there is not much affordable housing option for them. So the income inequality is pretty striking in the southern states. Did you probe the racial gap in affordability? My second question is, I also loved your last slide where you showed high share of aging housing stock in the rural Southeast Crescent states that are high poverty. It made me wonder if it's the demand side of the story or the supply side. While there is lack of investment in these pockets and new supply seems very limited, how has been the population trending in these areas in past few years? Has it been depleting in these neighborhoods due to lack of opportunity, spatial separation from jobs, and public amenities? Is it possible to probe the recent migration trends to better understand the demand side? And my last question is, Keith also showed that there is huge racial disparity in lending activity. Is there a dearth of financial institution in the high poverty Black tracts in the rural Southeast Crescent states that is contributing to this? Are they more likely to resort to predatory practices and alternative financial services for their financing needs? What is the racial disparity in home values in these regions? Is homeownership a wealth building tool for these communities?
Thank you, and thanks again for having us. Yes, those are great questions, and this is an ongoing research topic of ours, and I can start even with the last one. We have done in the past some research on like access to banking, and there is definitely a concern with in rural areas the declining number of banks. It's been a while since I've looked at. I think there's some new research out of the Fed or at Brookings about this issue, like in the Delta and nearby regions, where the number of banks has declined. There's actually more decline in suburban areas, but when one declines in rural areas, it means a lot more. And particularly in communities of color, there's just more lack of banking opportunities. And that hurts both in home ownership and access to mortgages, but also in small business. There's been a lot of research to show relationship banking. And if you have where the bank owner lives in the community and can make a decision, you're more likely to be able to get access to credit, as opposed to whenever there's consolidation and bank headquarters move to other locations. So I have no doubt that is occurring here, especially with the changeover to more internet banking. And I think that's really important. That'll be something important to look at, especially with regards to there's a lot of banking regulations coming up related to the Community Reinvestment Act and stuff like that. I also your other questions about affordability, I think you're right on. And that talks a little bit about what Zoraima was talking about too. There's very low incomes in these places. So while it may appear that it's very affordable, it is not very affordable if you don't have money or you don't have a history of banking and in the banking system, so where you could get credit, or it may be that you just couldn't actually quite pay the credit if it's too high. And the gaps are going to be, I need to do more of that, or there's going to be considerable racial gaps. If you look, and I didn't include this in the slide, that for Black or African American rural residents in that region, I think it's over 60% live in a high poverty tract, but it's only 30-some% for white non-Hispanic. So you can kind of see it's both extreme poverty and an isolation in many cases. And also your other point about the dearth of, I included that slide for the housing and how there's not many new units built, because I think a lot of times people think there's a hot housing market everywhere. And I like to just show that to show, look, there's not much going on here. And you're right, a lot of that would dovetail with population decline. In many of these places, we've done a good bit of research recently since the 2020 census came out on the changes. And many of these counties have had that. And I think sometimes it can be a vicious cycle, right? That like people are leaving, so there's no housing units. So then when you want to attract a business, there's not the type of units they would want. And so I think it creates a downward cycle. But there definitely would be some demand side pressures. Many of these places, particularly those that aren't at the urban fringe, would have declining populations, and that would be felt here. We also do a lot of research or work actually at HAC related to the people who are left, the housing needs. If you got an older stock and you got people who are older living there, it's a challenge sometimes to make the housing units. But those are all great questions, and I think this is an interesting all these presentations.
Thank you very much, Keith. All right, so lastly, Zoraima's presentation, it focuses on the Lower Rio Grande Valley colonias and showcases the disparity in rural and metro areas in the region. Her main findings suggest rural colonias typically have older population with limited income, assets, formal education. They have lower income, including that can go to the mortgage payments, lower savings, lower debt, larger share of population below the poverty line compared to the metros. They have lower credit scores and are more likely to be credit invisibles and are credit constrained. They are also more susceptible to trigger events or unexpected hardships that further exacerbates the inequality in a vicious cycle. And lastly, a lot of them live in aging housing stocks. So 3 questions for Zoraima as well. First, what are some of the unique challenges faced by the rural border colonias compared to other high-needs rural areas? What are some of the public health issues posed by poor living conditions, such as lack of drinking water, proper sewer lines, electricity, environmental issues such as proximity to floodplains, and lack of infrastructure? How that might have exacerbated due to COVID. These amenities are important factors as they hugely determine the extent to which homeownership can be a wealth building tool. My second question is, how is immigration impacting the living conditions? According to HAC's report, of the foreign-born population across the border region, non-citizens make up to 60%. How is their citizenship status and language barrier impacting their ability to become credit visible and get access to traditional financing mechanisms? Zoraima also briefly mentioned about the predatory lending practices in the area. Are the government programs that were launched to undo some of that working? According to HAC's report, many border residents use informal financing mechanisms to obtain homeownership, such as contract for deed system, which often involves high interest rates and does not protect their ownership rights. The Texas Department of Housing and Community Affairs started the Contract for Deed Conversion program, through which a contract for deed may be converted into a warranty deed, and the residents can thereby obtain ownership and property rights. To what extent are these programs working in the region, and if CDCB has any data to track their success? Zoraima, would you like to respond?
Thank you, Jaya. And again, just thank you for having us. Just quickly, a couple of things. I think in terms of what are some of the unique challenges that we faced along the border in comparison to rural persistent poverty regions across the country, specifically in regards to affordable housing, I would say one of the things I think when people often think about colonias, and I should say this too about why Alex's work is so important, there are real implications for how we define rural areas and colonias specifically. And I would argue that it is high time that we revisit just the definition of colonias. That is something that really impacts our ability to access funds to support homeowners in this journey. HAC has done some really amazing work around colonia investment areas. And I think it's, again, in terms of just definitions and how important that is for practitioners on the ground working with families, that's something I would just encourage more research and analysis of. In terms of infrastructure, again, yes, we spoke about the immense sort of what's going to stick with us from the outcome of 2020, 2021 is this idea of sheltering in place. And this was increasingly difficult for households that were in colonias, in rural areas, that were already facing high rates of housing instability. In terms of infrastructure, as I mentioned, many of the households that we serve are multi-generational. So you have older adults, grandparents, parents, children, often great-grandchildren, all living together in one household. What we witnessed during the pandemic is as housing instability increased, we saw more evictions, which again is something that you don't expect in rural areas. We don't see visibly households living in tent cities under expressways the way you do in major metropolitan areas. It's more invisible because households are more likely to take in family members, extended family, when they're facing housing instability. So another issue I think that is unique in our area, we also saw just the need for broadband services, right? This is something across rural America, but specifically in colonias and rural areas where we served, children were not able to get online to attend school. Elder adults weren't able to get online for telemedicine appointments. We had households that were literally sitting in a parking lot at McDonald's just trying to get free internet so their kids could attend school. So I think in terms of infrastructure, that's one area where we just need continued investment. And it's increasingly important on the infrastructure side. In terms of immigration that you mentioned, historically, we see in our areas about a third of the population. And this, comes and goes with migrant influxes. What I would say is how we respond and how we need, financial tools to respond are ones that really adapt and allow for credit history that's outside of what is considered traditional. So making rent payments on time, participating in a savings circle, and that is reported to a credit bureau, to consider some of those informal measures of credit debt and repayment history. And that enables individuals who don't have a Social Security number to also participate, to access a mortgage loan if they have an I-10 number and they've been paying taxes. And we also provide those free tax preparation services for individuals for an I-10. So I think to the extent that we can continue to encourage mainstream financial services to adopt some of the non-traditional credit reporting practices, that's going to enable more of the households that we serve to access mainstream financial mortgage products. And then lastly, in your question about I think to the extent that we, again, continue to see families that are operating outside the financial mainstream, contract for deed is an example of that. What we want to encourage households to try to participate in the mainstream to the extent that they can, but we also need great financial partners. We need financial institutions that provide products that are responsive to households, that meet them where they are, that don't have minimum balance requirements, that don't have excruciatingly high overdraft, protection fees. And as Keith mentioned, we need more financial services in the communities that we serve. I mentioned the ratio of mainstream providers is 1 to 22 just in Cameron County alone. So I think to the extent that we can continue to drive mainstream financial service providers into the regions that we serve, that will just increase our participation in the mainstream financial service sector.
Thank you, Zoraima. I think that was all great information. I think that we are on time, so at the top of the hour, so we won't be able to take audience question. But if we don't get to your question today, we will follow up after the conference for a response. Thank you so much again to all the speakers. As a reminder, the session recording will be available at the end of the conference. The deck for this session will be posted on the Resource Center. Your opinion matters. Please take a moment to complete the survey for this session. Now we will go on a 15-minute break and return at 3:30 with the last panel of the day on intersection of health and housing. Thank you for joining and have a great day.